What's up, guys? So I gotten this question in my ticket, and it was a really good question, and I thought I gave a good explanation. I think I'll get this question more in the future, so I think it's worth making a video on so you guys can also understand. So the question is, could anyone explain what I'm looking for when I'm looking at GEX and put call flow data? Like, how can that strengthen my decision? So the way I use data first is to develop a bias. Am I leaning long or short? And this is because I want the net flow to be on the same side as me when I take a trade. So when there are more net calls than puts in the market, it signals a bullish bias. You always want to play with the data, not against it. So okay, boom. Data is leaning long for the day. Now we look at GEX to find specific targets and see how price may act at certain levels. GEX is gamma exposure. When there is negative exposure, market makers have to buy as the stock goes up and sell as the stock goes down. Negative gamma means they trade with the market. When there's positive gamma exposure, market makers will have to sell as the price goes up and buy as the stock goes down, leading to a pinning effect. So think as negative gamma as ice and positive gamma as glue. And he asked a good follow-up question. So do you try to avoid a trade when there is negative gamma exposure? Oh, right here. And I had answered, not necessarily. Actually, I'll be inclined to take it if it's bullish, because I know the market makers will buy with the trend, not against it. Such as today on Rocket Labs. It was all negative exposure to the upside and no positive exposure above, which means there's nothing that would make price sticky higher, and it means continued buying. Same for the downside on a bearish setup. Let's take a look, and I'm going to insert my clip of the Rocket Labs trade from my live stream, and you can see how that played out. What a move. We're gonna squeeze here. So what's happening right here with Rocket Lab is we're running through negative gamma exposure. So through these negative gamma exposure zones, the market makers support buying the stock when it goes up, and they sell the stock as it goes down. So that's why we're seeing such fluid motion through these ranges right here. It's because we have complete negative exposure, and we've gotten over this wall where now that we're over 30, I think we're gonna continue up. We should see, if we could see this 31 Greek exposure increase, that would be great. Here's another example of a trade and how to use gamma exposure. this specific case is for 0 DTE trading. So I had signaled QQQ 593 calls at 56 cents. Very light because, first of all types of 0-day trading are inherently more risky than any other kind of position you should take. So I had signaled this because I had seen the exposure for the 540 shoot up to 80 million positive from the start, which was negative 20 million. So we had a good gamma flip, and it was still rising. It went to 140 million, and then it went to 250 million. So that was a significant amount of gamma exposure to where I knew it would be pulling the market to 540. Boom. 540 on QQQ, and that's where we ended up reaching.